A great way to increase your odds of success in a trade is to utilize something called multi-time frame analysis. And what that basically is an approach to the markets where you don't not only trade the time frame that you're interested in. So for example, that might be the 15-minute chart, but you're also willing to go above and look at higher time frames like potentially the 1 hour, the 4 hour, the daily chart to take your direction. So the whole premise behind the strategy or this approach to trading is saying that you're going to trade in the direction of the longer term trend, okay, but you're going to take your entries on a much shorter time frame. And what that allows you to do is still benefit from the tight entries and the tight stop losses, but also benefit from having the rest of the market behind your trade, as opposed to trying to trade in a direction that's against the major trend, which inevitably is always going to end up where, you get into a trade and it turns around. And I don't know how many of you watching this have been trading for a while, but I'm sure you've all experienced that, where you get into a trade and then almost as soon as you get into a trade, it turns around and it goes in the opposite direction. For the most part, this kind of happens because you're not paying attention to the bigger picture. You're kind of siloed and you're looking into the one time frame that you're trading, be it, a 1 hour chart, a 15-minute chart, or a 5-minute chart. But you're not paying attention to the bigger picture. Now, you don't want to kind of take this completely to the extreme, so only trade in the direction of the weekly chart, for example. But by the same token, you don't just want to be isolated to your one time frame of choice. What you want to do is you want to have a bit of a mix. So look at some of the higher time frames, but not too high, just enough that it's relevant for your particular trade, and then sort of hone in on the shorter term time frame for your entries. And what we'll do is let's take a look at some of these charts just for a little bit of an example of how this works. Now, I've got the Australian dollar chart in front of me. It's one that I used for the support and resistance level just now. So the same chart there, and I've got it in here because I think it just kind of highlights it perfectly. And also we had the trend lines in there. We had the support and resistance levels in as well. So if we were trading, okay, and let's say, for example, let's look at so we start with the higher time frame charts. We'll start with the 4 hour chart. If we were trading this market, we may see it here like this, right? This might be what we see on our charts at this particular moment in time. So we don't see what's happened in the future, but what we can see is that we've got a support level here, which is fair enough. We have our resistance level in here, and then we've got this downward sloping trend line. So we can see that the market from the 4 hour time frame, the longer time frame, is moving down. So from that perspective, we want to be involved in trades that are moving to the downside as well. We want to be selling the markets, because by selling in the direction of the major trend, you're increasing your probabilities of success. Whereas, if you were here, for example, and you were trying to buy this, and you weren't taking into account what the 4 hour time frame was doing, you could end up getting into a trade where it goes a little bit in your favor, but then it almost immediately goes against you. And then you wonder, why has the market gone against me? Whereas if you were willing to take a little bit of a step back and look at the longer time frame, so look at the 4 hour, for example, then you would have seen that actually, yes, I've got a downward sloping trend line there. So there's no wonder the market turned around at that level. If I had paid attention to that, I also would have been selling the market when it got to that level. Right? So how would we trade this? Right? Going back to this, we're looking at this market. It's moving down. Lovely. The next time it comes back to this trend line, we want to look for an opportunity to sell. So we look at this over here. We can see that the market is coming back to this area, and it's about about the 23rd of April. So then what we want to do is we want to go and take a look at our 15-minute chart. All right, and by the way, in terms of the time frames, I'm just utilizing a time frame that we use. I typically like to use a 4 hour chart for my analysis and direction, and like a 15-minute chart for entry. But you could use a daily and a 1 hour, or a 1 hour and a 5 minute, whatever it is that you want. It's just just as long as you understand these principles. So I've got this trend line in here from the longer term time frame. If I look at the shorter term time frame, so this 15-minute chart, it looks like it's trending up. If I were a rookie, I would be looking to buy over here. I'd be thinking, oh, this is a nice pullback. This is an opportunity to buy the markets. However, because I'm a professional, and hopefully you will be taking a professional's approach, I can see that there's a trend line in here because I've done my multi-time frame analysis. I've gone to the longer term time frame to get the direction, to pick the levels that are going to be interesting to trade from. So now, instead of being a rookie and waiting to give my money to the markets here, I'm waiting for some sort of a price action setup, some sort of a reversal pattern at this level. So I can see that the market's moving up to there. When it gets to this area, I'm looking for something that would indicate that the market is going to go in the opposite direction. In this case here, I would have taken a break of a support level. So I can see that the market's come up here. It's come down. If I put in a support level there, I could then wait for the market to break that level. So it's come down here. It's pulled back. The next time the market comes to this level and breaks it, that's an indication to me that this particular trend on the 15-minute chart, this upwards short-term trend, is coming to an end, and the longer-term trend is going to now kind of start to take hold. So I would start selling the market from here, expecting it to go lower. And sure enough, what happens? The market breaks beneath the level. It goes sideways for a little bit, but then eventually it does break down. And even if you went for this first move here, you would have got a nice easy one-to-one. Okay, so 1 times your risk. If you risked £100, you would have made £100. If you risked £1,000, you would have made £1,000, right? And that's ultimately how it works. You could have got a very nice easy one-to-one there. If you were looking for the bigger move and perhaps you were targeting the lows, then you could have got significantly more. You could have got like a 2-to-1 reward to risk trade. So you risked 10 and you made 20, or you risked 100, you made 200. And the beauty of doing things like that is that then you don't have to be right all the time. You could actually just be right less than 50% of the time and still make money. Not that that's the only way to trade. We also trade a strategy, one of our core strategies. Actually, we have a negative risk reward, but we've got a much higher strike rate on the trades that we get right. But, you know, there's no one way, there's no one size fits all. There are many ways to skin a cat. There are many ways to make money from the markets, and there are many ways to enhance your odds. And multi-time frame analysis is one of those approaches. So let's summarize. How do you go about multi-time frame analysis? You take your direction from the longer time frame. Okay, if you are trading, if you want to take your entries, you're a bit of a day trader and you want to take your entries off of a 5-minute or a 15-minute chart, then the 4-hour time frame is going to be enough for you. That's all you need to go up to. However, if you're more of a swing trader, you can't sit in front of your screens all of the time, and maybe you want to take your entries off of the 1-hour chart, then you want to be looking at something like the daily chart for your direction, right? That's just generally the way that it works. It tends to work best. So again, as with all of the other videos, go away and do some research, you know, backtest this, look at the longer term charts, look at the shorter term charts, see how it interacts, see how it could save you money as well. It's not just about making money on these trades. It's also about not getting into positions that don't stand a chance of making money in the first place. That's what so few rookie traders understand. They just can't get their heads around the fact that you want to take the high probability setups, you know, and you want to avoid losing money, because if you can avoid losing money, then you're going to make money eventually. If you destroy your account and you lose loads of money, you know, from the get-go, then when it comes to making money, you're clawing yourself out of a hole, right? You're trying to make back everything that you've lost, as opposed to just kind of trying to build your account. So really kind of think about that, all right? Preserve your capital. That's what a lot of this is about. So I hope you found value in that video. I hope you enjoyed it. I hope you're enjoying this little price action series that we're doing here. If you've got any questions, as always, post them beneath the video. Otherwise, I will catch you in the next video.